A very good evening to one and all. Thank you all for joining us, and I hope you all are in good health. I am CA Shreya Jain, your host and host for the masterclass on startups, focusing on angel investing. And today is day two, which talks about deals, and more deals. So I'd like to take this opportunity and thank ICI for starting up the committee on MSME and startups, and for organizing this amazing masterclass. Yesterday was day one, wherein we came to know about how to build our thesis. And today we're going to know more about it. We're going to know about how to get the deal flow and discover the startups. And for the same, today, the teacher of the masterclass, our special invitee, is CA Anjali Sosale, and she's a partner at Waterbridge Ventures, an early stage India focused seed to series A fund startup. Anjali, ma'am, focuses on customer tech and is based in Bangalore. She has over 15 years of experience in various parts of investment ecosystem, advising companies on their capital agenda. She started her career in investment banking with EY in 2006, where she spent a decade over multiple geographies and deal the advisory domains from due diligence to cross-border M&A and private equity. She was the instrumental in setting up early stage startup focused practice in 2014, which led until she left in 2017 to join Myntra, a Flipkart and Walmart group company and India's largest fashion e-commerce company. At Myntra, she was head of the brand accelerator program that sought out minority equity partnerships to jointly scale the next generation of D2C fashion and lifestyle brands in India. She took the program from idea and concept to scale, creating the first generation of D2C brands in India, diversifying the portfolio of 16 across lifestyle categories, introducing and expanding it into Flipkart. These brands collectively have now earned over $100 million in annual revenues for the group, making them into a valuable part of the ecosystem. So, ma'am, we all are intrigued to know more about the deals, and the stage is all yours.
Thank you so much, Shreya ma'am. And first and foremost, before I start, would like to sincerely thank my alma mater, ICAI, for giving me the opportunity, and the organizing committee for putting together this entire series of masterclasses, and recognizing the efforts and drawing attention to the startup ecosystem. So thank you all once again for inviting me and having me, and very much look forward to spending the next 2 hours taking you through the angel investing landscape, and how do you improve your deal sourcing, how do you improve your access to the best deals in the market, and how do you get more and more deals. So let's get started without any more ado. Shreya ma'am did a great job of introducing me. Thank you so much for the kind words. I thought I'll start by quickly doing a proper introduction myself, so that you have the context as well. The agenda really, like I said, I'll break it up into two big topics that I'd like to cover. One is objective, trying to give you as much data points and history of angel deals in the last 3-4 years in India, in order to give you a sense of the size of the market, the scale of the market. So we'll start with looking at some numbers. And then the second half is really what I like to call subjective, which is looking at strategy and some tips and some tricks as to how you can improve your deal sourcing, and how you can increase your network and your access in the early stage ecosystem. So very simple set of 20 slides only. And this is intended to be as interactive and engaging as possible. So feel free to ask as many questions, queries, comments in your chat boxes. And Shreya will accumulate these and ask them towards the end of the class. So let's start with the objective part, which is a look at the landscape. But before that, a quick walkthrough to my own journey, so you get a sense of where my insights and perspective is coming from. Shreya mentioned, I'm a partner at an early stage VC firm called Waterbridge Ventures, and I've been investing my entire career. I'm very much part of the same ecosystem as all of you are. I qualified as a chartered accountant in 2006, and since then, for the last 15 years, have only been investing. Very quickly about who or what is Waterbridge and what are our credentials within the investing ecosystem. As you all know, track record is the most important thing when it comes to being an investor. Some of the logos that you see here are our portfolio companies. We were very fortunate to sign Unacademy's first $1 million check. And we classic tech-focused early-stage investor. We do anything from seed to Series A investments. We are professional institutional fund managers, and we are currently investing out of a $150 million second fund that was closed, and we started deploying last year, that is 2021. We have over 27 companies in our portfolio and a founding family of over 60 founders. And we strongly believe in something called the high value add construct. And I'll cover this later on in the slides as well, as to how do we differentiate ourselves in this competitive ecosystem, and what do founders recognize as they interact and partner and work together with us. But Waterbridge has been around now for 6 years, so we're very young ourselves in the ecosystem. And on the right, you have companies, the company logos that we have backed and supported. Magic Pin, Unacademy, Chalo, Doubtnut are all on the B2C side or large-scale consumer platforms, and business is on the B2B side. So is Atlin, and City Mall is one of the early winners that we're seeing on the social commerce side of things. Very quickly to my own career timeline and journey throughout the investing landscape. This opportunity gave me time to retrospect and think about the total number of deals that I have been a part of and the total dollars of investment that I've had the privilege of managing. And as I thought through it, I simply put 4 buckets. I started in 2006 with my career in Ernst & Young in the due diligence team. I largely worked on growth, private equity, and cross-border M&A deals. And in those 3 years that I spent in that team, I had the opportunity to participate in over 30 transactions, mostly in IT services, and then secondly in real estate, because these were the sectors that had just opened up to FDI investing in the 2006-09 era. I then moved to the investment banking team to be part of the more upstream part of the ecosystem, where I spent a bulk of my time. I spent nearly 7 years in that team. I was a vice president and the head of the consumer tech and the startup practice later on towards the end of my tenure. And over here, I really did extremely large ticket size transactions. We did 50, 60, $100 million transactions and investments broadly across education and consumer. Fast forward to 2017, when I moved into Myntra and Jabong. Myntra and Jabong were both acquired assets with the Flipkart group. And over here, I was investing off a balance sheet. I think after 10 years of being an investment banker or an advisor, I was keen on moving to the principal side, as we call it. And then I moved into Myntra in 2017, where we were investing off the group balance sheet predominantly into D2C assets, as well as any other strategic company that boded well for the e-com ecosystem. Examples would be supply chain, logistics, retail tech, marketing analytics, etc. Made about 20 investments over 100 million in those 3 years, and really built up a strong profile as well as a founder network within the consumer tech part of the ecosystem. Fast forward to 2020, which is when Waterbridge came into the fray. We launched our $150 million fund that I referred to in early Jan 2020. That's when the first lockdown hit, and we've made about 14 investments in Fund 2 since then. We typically do 5 to 6 investments a year in the early stage side of things. We lead all our rounds. What that means is we like to be the largest and the first institutional investor on the cap table. Our preference is not to follow. And in these 2 years, or this is year 3 for me currently, but in these 2 years, we have done about 14 investments, just crossing over $20 million in deployment. And many of those logos were presented in the previous slide. But over the last 15 years, to summarize, I've been part of 70 odd deals, have a founder network of many more, and have managed close to $350 million of assets. There are a few assumptions to make before I start, given how subjective the space of angel investing is. And I know you're going through a masterclass series, but as I take you through my forward slides, I just want to make sure that we all understand the nature of this asset class. And I am assuming as a speaker that everybody is aware of the high risk nature that angel investing is, that the asset class is inherently very illiquid. The asset class is inherently very illiquid. As we know, it takes many, many years, anywhere an average of 7 to 10 years, to be able to sell and generate cash returns in this asset class. And my final assumption is that you are an interested stakeholder and you come with a basic level of knowledge on angel investing, and you're here to learn more about sourcing and building networks and getting access to the best angel deals out there in the market today. But just want to reiterate and spend a minute more on that. Angel investing is it's private asset. It's a private assets class. It functions very differently from the way the public equity markets function. And I hope that this buyer beware, and we're all aware of the long-term nature of this asset, as well as the high risk and, of course, high reward nature of the asset class as well. Let us start with understanding the size of the market and how the startup ecosystem has evolved in India over the last 10 years. If you recall, I mentioned that I started my investing career in 2006. And as I was pulling together data from Traction in the last few days in the run-up to preparing for today's presentation, I noticed that as an ecosystem, we were not even collecting data and reporting data pre-2010-11. So if I went back the last 10 years, you will notice that the total funding, which is both venture dollars and seed and angel dollars that has entered the ecosystem in the last 10 years, has grown significantly. Of course, to the far right, we see 2021, which has been the best and the biggest year ever for startup investments. India attracted over $50 billion, and that is more than 2019 and 2020 combined. And who would have imagined that all of this was through a global pandemic? Just under 10 years ago, this was a single digit billion dollar market, just doing about $5 billion in investing that came into the country every year. But the last 5 years has changed the landscape, and we're consistently hitting double digit billions. So you could see that from 2017 onwards, India is able to attract almost 16 billion plus in venture investing every year. In terms of the number of rounds, which is the yellow chart, the yellow line that you see going up, you could see that this data is from Traction. So we roughly had almost over 2,500 deals in the market last year, and again, growing significantly. So quick takeaway from this slide is that all of us in this room and attending the session today, I think it's important to acknowledge that we're very lucky to be part of this asset class. We're very lucky to be to aspire to be participants in this asset class, given the fast-growing nature of it, and that India has really hit that inflection point where we're finally able to attract over $50 billion annually in 2020. Even if we keep that aside, it is a fast-growing market, it is a large market, and we hope that it's only the beginning for the angel and seed investing ecosystem in India. If I have to quickly break up that total of 50 billion, or break up the annual investing number across the stages of rounds, starting from angel, seed, and then Series A. I've taken a cutoff at Series A because after that, typically angel investors do not participate. But if we look at the early side of the ecosystem, you will notice one thing with this slide, and I would like to draw your attention to, you would notice that the angel rounds, the number of angel rounds in the country in the same period have been decreasing, but the number of seed rounds in India have been increasing, right? Same thing with Series A. The number of Series A rounds have been increasing. There was a dip in the first quarter of last year when the lockdown hit, but then sprung up to an all-time high again. 2021, last year, you will see that angel investing actually hit a fair low, whereas the seed investing hit an all-time high, and the Series A investing hit an all-time high. I would just like to pause here and invite responses as to what do you think this signifies, or what do you think this implies for the early part of the ecosystem. Given the previous slide where we have seen that total investment dollars across all stages from angel all the way up to late stages of DEF was 50 billion, continuously increasing year on year in India from 3 billion in 2011 to 50 billion in 2021. But if I break that up into angel and seed, which is the early stage, which is what we are interested in here as a group today, you'd see that angel rounds have decreased, but seed rounds have increased. So I'll just take a minute to encourage each of you to share your thoughts as to what this could imply. Thank you so much for your responses. And yes, I think most of you have guessed right and punched in correctly. I think the big thing to notice is that the average round sizes have significantly increased with time. I think angel rounds have an average of $400,000 per round size, and you could see how that's going to $600,000 in seed. And what more seed deals and fewer angel deals means is that founders are raising higher amounts or higher round sizes, and they're raising those rounds earlier and faster. So capital is consolidating. People are skipping the angel rounds altogether and directly going to seed. And in seed, they're raising higher. And you could see that there's a roughly $200,000 difference between a typical angel round in India and a typical seed round in India. So the fight for you and me as people wanting to be part of this angel investing ecosystem would be, how do we get access and how do we break into this club of investors, right? How do we get to participate in what is an average of a $600,000 round? As an angel investor, typically people do not invest more than $100,000. By very definition, angel investing means that your ticket sizes are smaller. So therefore, if you have to stay relevant and if you're part of a typical round size of $600,000, can you do 50% of the round? Can you do 100% of the round? Or can you do 10% of the round? I think these are questions to ask ourselves so that we know what our own importance as an angel investor to that particular round is for a founder. Because no founder likes to go to more than a few investors for each round. Nobody wants 10, 20 people on their cap table in the first round itself. So founders are only going to max entertain 3 to 4 angels. So the ability to therefore cut those higher check sizes becomes critical in order to stay relevant to the way the ecosystem is evolving over the recent years in India. Also, just in terms of deal count, you will see that there were roughly 200 odd deals in 2021 at the 400K range, and there were about 1,600 odd seed deals at the $600,000 range. So as I said, more number of deals, but at higher round sizes. But the total market, the size of the angel investing market, assuming that it doesn't matter whether you're getting in at the angel round or the seed round, is roughly 1,800 deals in 2021. If 1,800 deals were closed, and we use the word closed when an investment is completed, if 1,800 deals were closed in the country, how many of those deals did you get access to? I think it very simply comes down to that. How many of those deals did you get access to the founders, to the pitch decks? Did you evaluate? And how do you improve your chances of participating in as many of these 1,800 deals as possible? So what is the secret sauce to getting a majority or as access to as many of these 1,800 deals? And that's what I'd like to share towards the rest of this presentation as to some sourcing tricks, as to various distribution channels, about building a profile for yourself. How do you stand out from the crowd? What is your own value add construct? And towards the end of the deck, we will cover how do you get more coverage and more access to this deal flow. But it's important to start by knowing that roughly 1,800 deals get done. These deal sizes are typically 400K to 600K. So you have a sense, given your own personal ability and the check size that you can cut. I hope this gives you a sense of what your own importance and relevance to that founder for that deal round, will be. The other thing to remember about angel investing is that mortality rates are high. I spoke about in the first slide about the being aware about the risk, the high risk nature, high risk, high return nature, and the liquid nature of the asset class itself. But here is some data to prove that. And I think it's important to put this upfront before we go deeper into the presentation. This data is for the last 5 years and updated last at the end of 2020. But if you look back at the last 5 years of the startup ecosystem in India, the 20th, the Pareto rule, which is 80-20, right? If I take a 20th decile cutoff, that's basically $10 million, which is where roughly my arrow points at. So the top 20 decile, the 20th decile startups in India have only the top 20th decile startups in India have raised 10 million or more. So what that means is, as an angel investor, you're mostly sitting over here where you've participated typically in $1 million round of the company, or maybe you've even done the subsequent round of funding and you've participated, say, in their Series A as well. But there is a high mortality rate after that. As you can see, very, very few companies, and to be exact, only the top 20th decile of companies go on to raise more than $10 million. This is data. So that gives you a sense of probability of success, and therefore all the more important for you to be participating in these deals, which get to the far right and have high probability of success. And of course, in our business, high probability of success is defined by ability to continuously keep raising money at frequent intervals, therefore giving you as the first and earliest angel investor an exit and a liquidity opportunity at the end of that 5, 6, 7 year horizon. So mortality rates in this business are very high. So it's important to be prepared and to know that there will be more losers than there will be winners, as is the case with any classic portfolio approach. And it will always be that 20th decile which will be successful and that will return money. But important to note again that it is high risk, mortality rates are high. And so therefore, the trick really is, how do you improve your chances of success, and how do you improve your chances of being in that 20th decile companies that raise more than 10 million and therefore go on to be more successful. It's also a good way of knowing what the trajectory of your angel investments are. Like, are these companies, I think 10 million is maybe the average, the median size to say that now the company is stable, secure, and the probability of success is higher if they've at least raised 10 million. What does this teach us, and what can we take away? What are the learnings from this slide and from this data point? For me, the biggest learning has always been that, yes, we make our money with our best investments, but we build our reputation with the ones that did not make it. As an angel investor, reputation is everything. And as much as we like to do due diligences and ref checks on our founders do the same with us as investors. So while, of course, everyone likes to focus on their successes and their winners and what returned them money and where they made their highest ROI and their returns, it's very important to note that for every one success, you probably have many more failures, given the high mortality rates the ecosystem very naturally sees. But that's where your reputation gets built. The company that you've kept with founders when they were not able to raise their next round. The difficult part of the founder journey, the 0 to 1, the difficult part of the founder journey that you were, and how useful you were to them, and how did you value add? How did you help them either make investor connects, or help them find customers, or help them find employees, help them with their talent hiring, or help them find vendors? But what was the value add you did to those founders in that early 0 to 1 journey? Did you actively help them raise follow-on funding? And what was the advice, the hand-holding that you enabled for these founders becomes very, very important. So my simple takeaway is, don't focus only on your winners. Also give in your best efforts and try to see how you can be useful, helpful, supportive to the founders early on in their journey. And that's where your reputation, your goodwill gets generated. And these are the founders who will probably refer you to their fellow founder friends, who will refer you within their networks as somebody who supported them when the going was not just good, but when the going was tough as well. And it's important to recognize that high mortality rates and failure is a necessary part of angel investing. It's a necessary part of the ecosystem. It is not something that should be stigmatized. And therefore, all the more reason to lend your support to founders, even when the going is tough. This is one of my favorite slides to present today, is to who are the top angels in India. I took this list from Traction for 2021, and I'll give everybody here a minute or two to just look through the slide and punch into the chat box as to, do you identify any patterns over here? Anything common that you see either with the investor names, I've put the top 8 of 2021, or anything common that you're noticing with the logos that have been presented on the right-hand side. But I'll allow everybody a minute and would love for more participation and people to punch in their answers as to noticing any patterns with either the investor names or with the startup logos that you see. But this slide presents the top angel investors of 2021. Great, thank you very much. I think, yes, it's very straightforward and easy. Everybody knows that Kunal Shah is India's biggest and most prominent angel investor. But I think the interesting pattern to note, and I was looking at the entire list last night, is that all of the top investors have been founders. Each of these investors have built, scaled, grown, exited companies before. And therefore, there's probably a reason why they're paying it forward and giving it back to the founding community and being top of the charts. And that's what I'd like to discuss in the next slide. But important takeaway is the top angel investors have all been founders themselves. They've all been entrepreneurs. They've been part of the scale-up journey. And therefore, naturally, as new founders enter the ecosystem and start up their companies, their first port of call, or their first preference for angel investors is like-minded people. I think that's very natural human behavior to seek out support from people who have been through the journey themselves. The other thing to take away from the logos, you would see that there are a lot of common logos across the top 8 investors. Of course, Kunal Bal and Rohit Bansal are from the same company, but you will notice like Razorpay across 3 of them, DealShare across 2 of them, Ola across 4 of them. But what do you think the reason is that there's so many common logos, and across these companies, there are so many common angel investors? If you pick out maybe the top 10 unicorns, or maybe even all the unicorns in India today, and map out all the angel investors, one stark data point that you'll realize is not only the names being these names we see on the slide, but significant overlap in the names of the angel investors and the portfolios of these investors amongst the top. I think the takeaway from that is really, why is this overlap and why are the deals concentrating towards the top, right? The best founders, the best ones, are choosing to accept our money. This is a choice. This is not a mandate. For founders, it is a choice whether to raise money from external investors or not. It is they are diluting their equity. So it's very important to have a reverse pitch, what I call what is your value add and what is your reverse pitch to entrepreneurs. If entrepreneurs are giving a share of their equity in their company and are choosing out of the very many angel investors out there today, if they have to pick out the top 2, top 3 angel investors to join their cap table, they are really the best ones who are choosing to accept our money. But what is our pitch to these entrepreneurs? What is your reverse pitch? Many angel investors say that I love to do angel investing. I have some liquidity. I would love to put anywhere from 5 lakhs to 50 lakhs into this company. But I always ask them, why should a founder pick you? I think it's a very powerful question to ask yourself, and would encourage each of you to reflect on the same. But there's always an argument that color of money is not always the same. So what is the value add that you're bringing, and why should an investor pick angel A over angel B? Is it just capital? Is it industry knowledge? Is it networks? Is it ability to put more money? But think about what is the reverse pitch to entrepreneurs, and why should, given that only 2 or 3 people will get invited to the cap table by this founder, why should that person be you? There is another interesting anecdote which I thought is worth sharing. This is from AngelList, which is the world's largest angel investing platform. And they literally analyze thousands of VC deals to try and see if there was a method to the madness, if there was a pattern that they could spot on how do you identify the best deals to participate in. And as the slide says, if you miss the best performing seed investment, you will eventually be outperformed by someone who blindly invests in every credible deal. And what this simply means is that angel investing is much more about not missing the big winners than it is about avoiding the losers. And this really is the answer to why we saw so many common logos in that previous slide, which showed the portfolio of the top 8 angel investors in India. Why was Ola across 4-5 of them? Why was Unacademy across almost every one of them? Why was Razorpay across many one of them? Because angel investing is as much about participating in as many deals as possible and not missing the winners than is it about nitpicking, evaluating, and trying to avoid the losers. Very simply put, you need to do as many deals as possible in order to improve your chances of succeeding. And often we say it's always better to put a consistent, similar check size into more number of companies in order to improve your probability of success and outcome. You're better off having 20 angel investments in a consistent check size than just trying to have one or two select nitpicked angel investments, even with a larger check size. Because what that means is that you're now depending on just 2 or 3 deals to succeed versus depending on, say, 20 deals to succeed. And the classic law and rule of, hedging your bets, improving your probability of success, and more importantly, having the capital to participate in what I like to call high momentum deals, or deals where you know they're pedigreed investors participating and it's a blind yes. And those are really the big winners, as we like to say. The names we saw on the top 10 angel investors, I mean, these are people who are founders. They don't do angel investing as a full-time job. And this is exactly what they're doing. They're blindly putting money into all the big winners and making sure that the best deals out there, they are definitely participating in those best deals. So given all this data, I think angel investing is really about 3 parts. One is capital, and this was part of my assumptions, so I don't plan to cover it today. The assumption is that everybody here is an interested angel investor and is curious and keen about this space, and therefore, of course, has access to capital to invest. The second is about access to deals, which is what I'd like to spend a large part of my time. And then, of course, picking or evaluation. Access is everything. As we have seen in the previous slides, the best deals go to the best founders, and only the top 20th decile even emerge as winners. And the winners only return your portfolio and make you money. So all the more reason to have first access, and all the more reason to be picking and evaluating wisely. So if you were to break this down into capital, access, and picking, and let's focus today on access and picking later on. So yes, I have given a lot of slides and made it seem that it's hard to get access to deals. And I'm sure the question on everybody's mind is cut the chase. And so how do we compete for deal flow in such a large market, $50 billion coming in, 2,000 deals? How can I be one of those? How can I be on one of those 2,000 cap tables? $600,000 is now the average round size. Does my small 1, 2, 3, 5 lakh check even make a difference? And how do I compete for good active deal flow? I've put it down to 3 things and like to spend 5 minutes on each of them. Feel free to ask any questions into the chat box, any jargon, any terms that you do not understand. Absolutely open and looking forward to making this interactive. So keep punching in your questions in the chat box, and Shreya ma'am will aggregate them and ask them towards the end of the program. So we compete by deal flow by going through some of the tips that I spoke about earlier as to what is your reverse pitch to the entrepreneur? What is your value add? value add can come from many, many different angles. And I know many of us, me included, feel that we're not founders. For me, I'm a professional investment manager. I have a track record, and I always use my track record, my experiences with founders, and my previous investment bets to showcase. That's my reverse pitch, saying my credibility, my track record, the value add that I bring, my sector expertise in consumer tech. That's my reverse pitch. But reverse pitch could broadly be around three, four things. It could just be deep pockets, meaning capital. As we know by definition, angel investors typically just do small checks once and don't normally do follow on. Angel investors don't continuously keep participating through seed, series A, B, C, etc. It's typically a one-time check just to help the company get off the ground, do an MVP, and to move ahead. But deep pockets could be a significant advantage to be able to tell a founder that, hey, don't look at me as only a first check or a single check. I am somebody who will continue investing in your company for the next 3 rounds, for the next 4 rounds. Don't look at me as somebody who's only investing 2 lakhs today, but I have the ability and the intent, more importantly, to invest up to 20, up to 30. But it'll be good if you could communicate to the founder a number saying that this is the allocation I have in mind today, and this is the allocation that I can put on what we call follow-on capital. And deep pockets, access to capital pools, and the ability, therefore, to continuously support a founder via equity capital could be a significant value add. But it's important in your reverse pitch to explain to a founder whether you're a one-time angel or whether you're the kind of angel who likes to participate in follow-on rounds as well. Because obviously, anybody and every founder would be more keen on bringing on an angel that has an ability to do larger tickets, do more follow-on funding, rather than an angel who's just going to give a single check today and then disappear, and I have to anyways find new investors for my next round. Capital runway, as we call it, and the ability of my existing investors to follow on is always very important for founders. So deep pockets could be one significant value add. The second could be industry experts. I think, remember that most institutional VCs are not sector focused. Most VCs in India today are tech focused, but sector agnostic. So even if they go to a VC and raise capital, VCs are typically either not operators, they're professional fund managers, as I mentioned. So they may or may not have deep industry knowledge and expertise. So industry expertise is a differentiator. As I mentioned, I've always followed the consumer tech ecosystem and the e-commerce ecosystem. So I focus my deals only in this space. Most people know me as, if you want to invest in a consumer tech deal or a B2C platform, please reach out to Anjali at Waterbridge. So I think it's important to build that industry profile and expertise for yourself. And that could ideally come from what your profession is, where you've previously worked, or if you're a founder and an entrepreneur yourself, in which sector have you started up? If you're in healthcare, for example, it makes sense to only focus therefore on healthcare deals and healthcare founders, because you'll instantly connect with the founder, you'll be able to add value, understand the business model, and founders will instantly recognize that, and that will make you stand out again from the remaining angels that a founder typically solicits. But industry expertise is again very important and differentiates you and could be part of your reverse pitch and your value add to founders. I always say that in early stage, we invest in people, not in businesses. And it's a 0 to 1 journey, which is the hardest. So here founders are typically just trying to find their first customer, find their first MVP, run their first pilot, hire their first employee, build out their first industry partnership. So if you come from that same industry, and if you could be like, hey, I can introduce you to the CTO at Flipkart, or I can introduce you to XYZ in this company, then that is very precious and valuable to a founder and makes you stand out compared to anybody else. The third one is domain expert. The reason I put these out separately is when I say domain, I mean more functional expertise. Are you from HR? Are you from marketing? Are you from tech? Are you from finance? And those could be another vector in which you bring in special experience and special knowledge. Can you help be the virtual CFO till they find a full-time CFO? Can you help with HR processes and policies? You come from a legal background? Are you an expert at at marketing, so you help him reduce his customer acquisition cost. I think domain expert could be another potential area where you could deeply value add to a founder and help him be more successful. Angel investing, again, it's not about just signing a check and being a passive investor. It's about being an active investor and actively participating in the company to enable it to be successful and to move to that far right that I spoke about. And how do you enable them to keep raising more rounds of funding? Finally, tag-along angel. I think tag-along angels I've put last and fourth. And I call these angels more like groups, where you're part of a larger group where people know that, hey, if I reach out to this person, then they are part of a larger group of investors. So just one call to Anjali would mean that she will bring in 10 more people onto the cap table, so that my efforts to find angels, reach out to them, reduces, and Anjali kind of front ends it or process manages it on behalf of the remaining investors, which means that you're enabling the founder to raise maybe the entire round. Coming back to my 600K average seed deal size example, if I could just come to you and you will bring in more angels and help me to close out the entire 600K round, then again, for me, it's faster, it's easier. I only have to deal with one person, not deal with multiple people. Any questions, no fuss. I'm simply what we call those tag-along angels. You find an anchor whose investment thesis and track record that you believe and trust, and simply tag along with that group. So no fuss could also be an advantage in this business. That's the 3-4 things that I would suggest in terms of how do you think about your value add and how do you think about your reverse pitch. I will now move on to the next piece, which is, does momentum matter? Many a times I do get asked this, saying it's chicken and egg, Anjali. People say, show me your track record. Who are your other angel investments? But how do you get started? And of course, we're all competent financial professions. So we all know that the more you sow, the more you reap. So you need to do more of something to gain experience in it and to build a fine eye, as I say, because in early stage, we're always crystal ball gazing. So how do you build investment patterns, evaluation patterns? And it's almost like the cold start problem. So how do you get started? This business is about networks, and the flip side is that networks always compound only with time. This is a long game. So just requesting participants to mute themselves if they've not already. Yeah. Thank you so much. Sorry, I got distracted thinking that was a question. I'll come back to, does momentum matter? So as I was saying, that this is a business where you see returns only in the long haul. You're probably building a track record only over years, not months. Even returns and success is very long drawn out. It is inherently a long game. I always say that in early stage investing, success is long drawn, but failure is immediate. And what I mean by that, it takes a very long time to be an angel investor, say in a unicorn, to be able to get a cash exit, to make a successful return for yourself. But typically within 12 months to 20 months, you would know whether your non-performing assets, you would know about your non-performing assets. You would know about the deals that don't do so well, but you'll still have to wait it out for the ones that do well. So how do you get started? Where do you get started? And that is something that will need slides of their own. So I will keep that on pause and come back later on the cold start problem and how do we actually get this momentum going? How do we get to see more and more deals so that we can participate in more and more deals and so that we can evaluate deals faster and better? Finally, many people always joke saying, is angel investing an expensive hobby? I think it's a very important question to ask given the high risk, high profile nature of this asset class. And it's very important to ask ourselves as to how much time are we willing to spend? How many deals do you want to be a part of? What is your probability of success? And do you want to do this full time? Do you want to do this part time? Do you want to do this only in industries that are important to you and that you understand? But even for founders, it's very important to know how much time you are giving them. Are you a passive investor, like you'll just cut the check and forget about it? Or are you the kind of investor who will give 1 hour a week? Will you attend every board meeting? But how much time are you willing to give the founder? Because for the founder, again, it's not only about money, it's about what else is that money giving me? Is it giving me access to time? Is it giving me access to networks? Is it helping me scale faster, open doors faster? So how much time are you willing to invest in part of your reverse pitch? I would again encourage you to definitely set the expectation with founders as to what is the amount of time, energy, and effort that you are willing to commit to the founder. And founders always appreciate when you say upfront whether you can give X amount of time and value add, or whether I'm a no fuss tag along angel, I will just sign the check and forget about it. We have all kinds, but as part of your reverse pitch, we encourage you to therefore commit to a founder an amount of time. So this is what I would encourage you to put in your pitch, your reverse pitch. Think about your value add. Try to build a track record. Speak about your track record. Once you decide to step into angel investing, remember that it's about momentum. So it's something that you'll have to continuously do over many years in order to get good at it, to get better at it, and to start showing returns and building deep networks. And finally, don't look at it as an expensive hobby, but think about it as to how you can commit time to founders, and think about the value addition that you can give to founders with this time, because not all the color of all money is not the same. Finally, time and trust are very critical in early stage investing, and we need to source and close quickly. As much as I spoke about the approach in the previous slide, I think it's important to add the layer of time. And very, very often, angel investors get very little time to decide whether they want to participate in a deal or not. So all the more reason to keep a pitch ready, all the more reason to know how much time you want to commit to the deal, all the more reason to decide what is your ticket, and standardizing some of these approaches, as I was mentioning, have a consistent ticket size that you want to invest in every deal. Decide what your sectors are. Decide what your value add is going to be. Decide how much follow-on funding you're going to do, and don't change these deal to deal, because time is super critical. Founders typically don't give the best founders the best deals close in a matter of weeks, not months. So it's very important to be able to give a founder an immediate feedback. Typically, founders only do 1 pitch call with angels or 2 pitch calls with angels and expect a commitment at the end of those 60 minutes. So if you have to take decisions this quickly, it's important to build some of these patterns in your head, or some of these standard processes in your head, so that when the opportunity comes to you, you're able to grab it quickly or decline it quickly as appropriate. But time and trust are critical in early stage investing, and you not only have to source quickly, you also have to close. You have to close quickly. And the reason I've put this out is because this significantly compounds on your ability to source deals better. If you start getting recognized in the ecosystem as an angel who doesn't waste time, who takes decisions quickly, that will have a major positive rub-off effect on your ability to source deals, because time is money for founders. They don't want to spend too much time. For them, for founders, it's a matter of literally starting their company or killing the idea. And so closing the first round is always the hardest and the most difficult. So founders will always select, choose, and go with angels who are able to move fast, take decisions quickly. You have to always be available. And once you start getting recognized in the ecosystem as an investor who doesn't take too long to decide, who's very clear on the sectors they want, very clear on the amount they're investing, very clear on how they will add value, founders instantly recognize that to say, and start recognizing you as the right angel investor to bring on their deals. And that will on its own compound and enable you to therefore source better deals over a period of time. But remember that time and trust are critical. In most of the cases, you will not be given more than a few weeks to evaluate a deal. So a fair bit of homework in some of these areas will help you. Finally, I always get asked, how do you decide so quickly? In fact, I recently wrote a blog on my LinkedIn as well on how do we decide so quickly, given that everything moves so fast. How do I take a decision, literally with my hard-earned money that I'm investing? How can I, in 1 week after one meeting, decide whether I want to invest in this company or not? I think the best way to answer this question is to say that there is no such thing as building 100% conviction. As I mentioned previously, in early stage, we invest in people more than we invest in businesses. We should always put founders ahead of markets. And early stage investing is a combination of science and art. And it's a combination of intuition or gut, as we say, as well as information and data. And all of this, of course, only comes with practice of seeing X number of deals to know what stands out, to know what is unique, to know what is common. But even the best of our deals and all those logos and the 27 investments that even we have done in the last 2 years, if you ask us if we have 100% conviction when we signed the first check, we always say that there are always open areas. There are always areas that you have conviction on and areas where you need to build conviction on. But as long as you're living to live and go with the flow and you've identified areas where you need to build conviction, I think that's more critical. There's no such thing as husband condition. Quickly identify areas where you think you need to build more conviction on and judge whether you can live with it or not. But it's always a science and an art. It's a combination of intuition as well as information, I would say. How do you diversify your sourcing networks? I think most of us are always wondering, how do we get access to more and more deals? And how do we see more deals in order to become more knowledgeable about something? Just hold on, I'm just going to get this to load. Yeah. You could diversify your networks by sourcing from different channels. So I think I've given a lot of tips and tricks so far, but now this is where the rubber hits the road. And this is more of who do you source from, right? How do you diversify your networks? How do you start? How do you get started? How do you really hit the ground running? How do you be more visible in the market? And who do you source from? I think I've put out 5. There are many, many more. But as I was thinking about the big, broad 5 categories, I would bucket the 5 categories as firstly, investors. By investors, I would largely refer to early stage investors and typically the investors who would come in next after you in the round. So if you're coming in the angel round, start building out an active network of seed investors like ourselves at Waterbridge, who are typically the first institutional VC on the cap table. How many such investors do you know? And start actively reaching out to the investor community, the seed investor community, and start building your networks. Because typically a lot of these investors themselves will start inviting you onto cap tables and will start sharing their own deal flow with you. So one way of just increasing your deal flow is improving your networks with the early stage investors. And these could be peer investors. This could be investors who come in at the seed stage. I think I would encourage you more to connect and network with seed stage investors rather than growth stage investors, because they come along much, much later. But be very closely networked and actively reach out and seek out investors who would come in the immediate next round, and try to be part of as many of those networks as possible. Literally map out these investors. We have more than 100 such investors in the country. Literally map them out. See in your first degree and second degree networks whether you could reach out to people in these funds, speak to them on a quarterly basis, understand what deals they're looking at, what are the sectors that they have built high conviction on, what are the themes that they are likely to chase deals in, and then you could work backwards from knowing that, okay, this fund, for example, we know that in 2022, early stage investors, for example, and hypothetically speaking, are not very bullish on live learning platforms in edtech, right? Or are not very bullish on extracurricular live learning for kids. But this knowledge you gain only by speaking to investors who would come in next, and by understanding their own investment preferences, that will help you take better decisions on whether you should participate in a deal or not, and obviously improve your chances of success, because you know that EV, electric vehicle platforms are not like are on the negative list currently, or cryptocurrencies and marketplaces are on the negative list. Or what is bullish, that pet care, for example, it's a very bullish space today. Or D2C personal care brands, clean organic brands are very bullish today. So once you start speaking to more and more investors, you could quickly identify a set of subsectors which are on the positive list as well as the negative list, because investors by default see at least 100x more deals than you would see as an angel investor. So therefore, their worldview and their point of view would always be from a larger base, and they would give you deep insights into improving your own possibility of success, so that when you get deals, you know that I shouldn't look at this company because from all the investor conversations I've had, I know that this year, these are the sectors that are doing well and these are the sectors that are not doing well. Momentum, again, is very, very important, and early stage investing is about catching trends early. So you need to know what are those trends that are up and coming in the market and are finding flavor with the next level, next stage investors. Founders. I think the next place where you should source from is fellow founders. This is, I think, the easiest part to do because founders are all pervasive. It's very easy. And today there are multiple organized networks that you could be a part of in order to interact and meet with as many founders as possible. And founders are extremely social, versatile people who never say no to new meetings. So meet as many founders as possible, express your interest to invest, sell your reverse pitch, speak about your reverse pitch, wear it on your heart and sleeve as to what kind of deals you're interested in participating in. The founder community interstate themselves is very, very strong. And founders, even if you said no to one founder, if that experience of pitching to you, having a couple of conversations with you was pleasant and was value additive to that founder, they will always remember this. They will always pay it forward. And you will see with time that founders themselves start referring more deep into that network is very important. So every time a founder pitches to you, don't look at it in a silo or singularly with regard to that founder and that pitch. Think about building a longer term relationship and seeing how do you make that pitch memorable for the founder. You're possibly meeting 10, 20, 100 founders in a month, but for that founder, he's only meeting 3 or 4 angel investors. So he will remember this meeting, and it's important that you also make the meeting count, and that always leads to referrals further down the line. Angel peers, I think this is again very critical and very straightforward. Even if you want to be, if you're compressed for time, if you're a Tagalong angel, you're not very fussed about sector, the best thing to do, like I said, is to find an anchor investor, find somebody whose investment thesis is that you believe in, whose track record that you've admired, and join them as a group. And so angel peers are very similar to investors. Angel peers tell you what the trends of the season are. They tell you what are the hottest deals and the deals with high momentum, as we call them. And they would also pull you into deals, especially if you have an industry expertise or a domain expertise. If you start getting recognized as somebody who has deep expertise in consumer tech, when another angel peer is looking at a consumer tech company, they will reach out and seek you out to say that angel A should definitely come on to this cap table because they're deep sector knowledge in consumer tech. So I think angel peers help the same ways investors do, but to bring you into that deal. I think investors is more from the next deal and the next round, but angel peers always help to get access and widen your deal flow. Angel peers is also important from knowing what the terms of the deal should be. Should the deal is the deal overvalued? Is the deal undervalued? Is the founder preference for a straight equity? Is the founder preference for a convertible? But talking to your angel peer group always tells you whether you're valuing a company correctly, whether you're asking a founder for terms that are standard in the market or not standard in the market. And it also helps you benchmark yourself in the competitive landscape. Peers are also competitors. So it helps you understand the quality and the quantity of angels that are there in the market and how therefore you need to differentiate yourself from the pack. The fourth is ecosystem enablers. This is, I think, the easiest to do. and the fastest growing in the Indian ecosystem. Ecosystem enablers, examples of ecosystem enablers would be, for example, industry bodies. It could be like a T-Hub or a TIE. This could be corporate accelerators. This could be campus programs. This could be angel investing syndicates. This could be even media publications that organize events, webinars. But getting access, participating in the ecosystem enabler space is the most publicly available and accessible out of all the 5 that I've put out here. It might still be hard for you to find angel peers. It might still be hard for you to get started on meeting VCs and getting time with investment professionals at VC firms. But ecosystem enablers is I think the easiest way to start. Even before you decide to start doing angel investing, these are all publicly available events, webinars, and given the pandemic, there have been so many webinars out there which actively encourage registration. So would encourage each of you to participate and get a sense of the discussions that happen there, the kind of founders that come and pitch. Every day we see some demo day or the other going on, whether it's NASCOM, whether it's like 10,000 startups. But being part of these ecosystem enablers, these industry bodies, think tanks, definitely, again, give you access to deals, but more importantly, keep you updated on the space and give you visibility as well. But it's also a good starting point for you to assess whether you want to be part of this and how actively do you want to involve yourself. I think finally it's outbound, or you could also call it direct. Again, this is very important in the early stages till you build a track record and till people start coming to you because they recognize that you are a prolific angel investor. So if you're not amongst those top 8 or 10 names, then it's fair to assume that people do not know us. We need to sell ourselves, and we need to actively encourage, actively convince founders as to why I am best suited to be an investor with them. So I think investing is all about partnering. Don't look at yourself as an investor in a company. Look at yourself as somebody who's partnering with the founder. And I would also therefore put outbound to begin with. By outbound, I mean that you directly seek out founders. So whenever you get to know of a deal, or even when a deal has been immediately announced, say in a media publication, you literally either cold mail the founder or find a way to get a warm introduction to the founder, but actively reaching out to founders and to companies that you admire, that you want to be a part of, or where you can add value becomes extremely critical. And again, it differentiates you from the rest of the angels in order to be able to tell a founder that, hey, I read about you, I heard you've raised a 1 million round. Is there any opportunity for me to participate, right? And then the question is why, and you would follow it on with your reverse pitch in terms of I've spent X. If this is a healthcare company, then you go with your reverse pitch on how many years you've spent in the ecosystem, what are the networks you bring to the table, how you're very intrigued by growth, how many hours you can give a week. But I think outbound, like actively seeking out companies where you admire the founders or admire the business models and want to be a part of. We have seen several examples where founders actually appreciate it and give allocations to angels who have sought them out rather than vice versa. And that's also necessary to get started and to break the cold start problem that we spoke about. But very simply put, to summarize this slide on who do you source from, I would summarize it as increase your deal flow by building relationships with other active investors. And remember that deal flow is reciprocal. Don't think about only how to increase your deal flow, but think about also how to share other great deals with them. And if you remember the previous slides, angel rounds by default and angel rounds by definition are not raised by a single angel investor. By definition, there are 3-4 investors in every round, which means by definition, this deal is shared between multiple people. So there's no harm, unlike with institutional VCs, where it's typically one VC who wants to come in and doesn't want the other VC to come in. With angels, you have the benefit of actually inviting, welcoming, and sharing deals more freely in order to get more people to come on to the cap table. By definition, an angel round, you never see companies where there's only one angel in a round. There's always multiple angels who participate, which makes sharing a necessity. So share great deals with the team, with founders, and be reciprocal. Be reciprocal as well. The other thing that reciprocity helps is just to know whether your deal is widely circulated or is your deal exclusive. As we know, this entire space works on information asymmetry, right? It's about who gets access first. We spoke about time and turnaround times needing to be quick. But as you start sharing deals within your trusted network of angel peers, you'll quickly understand whether he or she has already seen this deal or you're sharing it for the first time. And you'll also get to know the length or the duration that this deal has been out there in the market. And that's very, very critical. Because if a founder has been in the market for a very long time, you know that the chances of success are already low. It's only taking, in today's ecosystem, it's only taking weeks to close deals. So if a founder has been out in a market for many months and still not closed around, that in itself is a signal that this deal has taken too long to close. The hottest deals get oversubscribed. The hottest deals, you're fighting for allocation. So if you share a deal with somebody and that person tells you, I saw this deal 5 months back, I think that itself should raise your antennas as to why has this deal come to you so late. So sharing with peers and doing outbound also helps you understand and measure, if I may, your own speed. Where do you start? I think we spoke about what you need to do, what your strategy should be, who do you go to, and how do you diversify different sectors. But I think finally what we're really getting down to is, can you name places? Like, what are, like, this is a tactical part, like what are the specific areas, specific incubators, specific accelerators, or specific distribution channels that you could use in order to source more deals? It's a long list, so I request you to please bear with me, and I will go through one by one. But I was trying to put all of them into a single slide to say that there are multiple places where you could start in terms of deal sourcing. And to ask a VC investor, how do you source more deals, is to ask the VC investor to give away their secret sauce. So in many ways, I guess this is the secret sauce, and you have to do this as always. You have to compound this over time. So you have to keep doing this over many, many years for the compounding effects to really start playing out. But this is a long list, and let's start. So the first one I would say is be part of angel networks and syndicates. I think this is a huge positive move that has happened in the Indian ecosystem in the last 3-4 years. We've had organized, formalized angel syndicates, licensed angel syndicates. So it's become, angel investing has become very, very democratized. It's become very easy to get access. And so would definitely encourage each of you, depending on your ticket sizes and preferences, to sign up to be part of these angel networks and syndicates. Many of them are even free to sign up. Many of them, the commitments to sign up are fairly low and therefore easy to access. But it's a great must-have starting point. Let's Venture is a great platform. AngelList is another great platform. But there are multiple platforms like this in the market, and would definitely encourage all of you to not only focus on direct investing, but also do it as part of syndicates. What syndicates help you achieve is scale and width. They, as I was mentioning before, investors and fund managers and organized syndicates always see 10x, 100x more deals than you would see as an individual angel investor. I'm also assuming that as an angel investor, you're not full-time, you're doing this only part-time, you actually have a day job. So you can't devote all day, every day to sourcing deals. So therefore would encourage you to stretch and expand your net wider by being part of these syndicates so that you see more deals. And therefore, again, you'd be able to quickly get access to more. The more the more you sow, the more you reap. Stay close to college campuses and their incubator programs. Again, we're seeing like all the best colleges in India, almost everybody has incubation centers. They run a lot of demo days, startup programs, business plan competitions. A lot of these is open to everybody. As VCs, we always get invited, but these are today, again, one of the benefits of the pandemic have been just democratized access to some of these events. But would encourage you to
to stay very close and track and trace college campuses and incubation programs, especially business plan competitions, to see what the trends are. Again, just attending these demo days help you understand what the next generation of founders will build, right? Like, what are the themes? Are they thinking about esports? Are they thinking about mobility? Are they thinking about social commerce? But it quickly helps you understand what the themes or flavors of those season are. It helps you catch some of these trends early, and you could always use that information to compare it with the deal flow you already have, to therefore know what deals are indeed unique and what deals is very run of mill. If you're attending a campus demo day and you're seeing many quick grocery or 10-minute grocery startups, you know that is an overfunded, overheated space. And then, so I think staying close to college incubators and campuses always help you catch trends early and help you understand what the next wave of innovation is going to look and be like. I've named a few here, some of the biggest ones like CII out of the IIM Ahmedabad campus, or IIT Mandi, or BITS Launchpad, which is in fact happening in the next couple of weeks, or the eCell at IIT Bombay. But I would say very simply, trace down all the large institutes depending on whether your preference is. If it's healthcare, then chase all the large hospital chains and medical institutes. If you're more tech focused, then make sure you're attending all the IIT events. But these really give you, and all the big, say, B school business plan competitions. But this really helps you get a flavor of the early trends and innovations that you will see in the ecosystem. The third is to follow and track corporate accelerator programs. And all this, it has been really amazing to see all of this flourish in India in the last 3-4 years. I think less than 5 years ago, we never had formalized corporate accelerator programs. But today, they are all the large corporates, whether it's the big unicorns in India like Flipkart, or whether it's like global MNCs and behemoths like NetApp, Cisco, Google, even Target. All of them run accelerator programs. So again, these are accelerator programs that they typically run once a year. They announce the cohort. It's a public demo day. Typically, these videos are available on YouTube, on LinkedIn pages of these companies, but they give you access to listen to the entire pitch. And then this is when your outbound comes in. So if you have just seen the Google, in fact, 2 weeks ago announced class 6 of the Google Startup Accelerator program. So put down a list of all the corporate accelerator programs in India today, and every time the demo days are out, sign up, register. If you like a company or a founder, outbound, seek them out, reach out to them, write to them on LinkedIn, find a common connect, and find a way. Because when it's out of a campus, or when it's out of a corporate incubation or accelerator program, that's when they're ripe for their first round of funding. So they will be by default and definition early stage, and that's the right time to reach out to them, because even a few weeks afterwards, they would have already raised their 1-2 million or their first round of funding. So immediately after they get announced will be the right time to reach out to these companies. I've only named a few and some of the best, but there are many today. Once again, would encourage you to apply a sector lens or an industry lens. For example, if you're very interested in retail tech, then Target is relevant because Target only does retail and consumer analytics. If you're interested in e-commerce, then the Flipkart program is great. If you're interested in deep tech, NetApp and Cisco only focus on B2B and deep tech companies. But it's important to know what your preferences are and chase those programs where some of the best founding teams come out and graduate from. The next idea is to scout for VCs. I think especially if you're a founder yourself, or if you have a particular sector knowledge or a domain expertise, a lot of the VCs, us included, we run scout programs. And what scout programs mean is that we seek out individuals, entrepreneurs, founders, sector experts to go and source and scout, like literally scout deals for us. And many of these programs are informal, many are formalized. But again, as part of the previous slide, when I spoke about ensure that you have quarterly meetings with VC investors, as many as you can in your network. Also actively inquire about scout programs that they run, and to see what would it take for you to qualify for one of those scout programs. But this gives you direct access, and these programs are typically always reciprocal. So the more deals you share, you're at least guaranteed of an allocation on those cap tables. And because these are deals that a VC will do, probability and chances of success are naturally higher for deals that you scout for VCs as well. The next one is become an LP. I know that this is an obvious path to many, that many people do not want to do angel investing, again because of time constraints or because of not wanting to spread your risk profile and rather hand it over to the professionals. So becoming an LP in a fund is, again, something I would definitely encourage to diversify your risk profile. You could continue doing direct. You could continue being part of angel syndicates, but also look to become an LP. And of course, there's a stack rank and a hierarchy. Even over there, you start with becoming part of an angel syndicate or a network. Then you move to becoming an LP in a micro VC. And ticket sizes have significantly reduced. The other advantage of having $50 billion pour into the ecosystem and have the startup ecosystem do so well in the last 3-4 years is that just the access to becoming an LP in some of these funds has greatly democratized. So I don't think the ticket sizes are as high as $1 million, $2 million anymore. And you could reach out to multiple micro VCs in the ecosystem that and at least inquire about what their check sizes, minimum commitment check sizes would be. And given that capital calls and capital commitments typically happen over a 2-3 year period, I would definitely encourage you to explore becoming an LP, at least in a micro VC, if not a larger institutional VC. Finally, I think the next idea is to network with employees of unicorns. Another pattern that we've studied, and that's again openly available, a data point, is that the most probable funded startups are typically founding teams that come from startup backgrounds and startup experiences. So I think staying very close to the large unicorns and staying very close to what is happening inside of these startups is super critical for 2 reasons. One is, of course, the teams that break out of there and end up starting their own companies. I'm sure many of you have already noticed when deals get announced that these founders are typically ex-Flipkart, ex-Swiggy, ex-Zomato, but they come from prior startup experience. So staying close and seeking out friends, family, professional network in the unicorns, again, gives you access to teams early. And literally when these teams sometimes are even just ideating or thinking of breaking out, you would get access. You get access to some of these deals. And the second reason, which is more important, I would say, to always stay very deeply networked with friends and employees in unicorns, friends who are employees in unicorns, is to gain knowledge about the inside working, the strategy, what are they focusing on, what are their own priorities, because that would again help you evaluate deals better. I think it's super important to know what the immediate strategic priorities of these companies are. It helps you understand competitive landscape, competitive advantages, and whether you want to go up and fight against a large company that's already building in this space, or you know for sure from your network inside that they're not going to be focusing on a particular sector, and therefore you can take a bet, an angel investing bet in that space. But for 2 reasons, competitive knowledge and also access to breakout teams, I would definitely encourage reaching out to employees and teams that work in these large companies. Support other ecosystem enablers. Again, like I said, this is a new and emerging space in India. Every day we have new platforms coming up, programs coming up. T-Hub is doing a brilliant job of encouraging early stage founders with the incubation program. TIE has chapters in every city, heavily founder focused and entrepreneur focused. Atal Incubation is doing brilliant work, that too with a very strong sector lens to it. So you could literally tie up with them only for a particular sector. Then you have private volunteer networks like Head Start, for example, that's doing a great job of volunteering people from many of those unicorns that I spoke about to help aggregate deals. bring deal flow, organize demo days, organize investor connects, investor sessions. But there are multiple ecosystems arising, and again, they'll help. They're just extra feet in the market for you to aggregate deals, show you better deals, and that is quickly becoming a very important deal sourcing distribution pipe. Then the other two, I think, following the final two, rather, or the final three, I would say, is follow SaaS company startup programs. Now, this is a very unique bullet that I've put here, and I don't think many people think about it as an obvious place to go to source deals. But most of the large SaaS companies in India today, who are operating in India today, run what we call startup programs. Freshworks, of course, is the biggest. I would encourage you to go and follow their website. But just to take an example of what they do and how is it important for us and for this discussion. Typically, these startup programs do two things. One is they give free credits and discounts to their own products. So if it's Freshworks, for example, Freshworks will give credits and discounts to the Freshwork tools for early stage startups only. And early stage startups is typically defined as startups that have not raised more than $2 to $5 million in funding, and startups that are less than 2 years in existence and have, say, less than 1,500 employees. But if you fit that definition, which is what all of us as angel investors will seek out deals in, you are eligible for credits from all these large companies. So whether it's Zendesk, Zoho, Freshworks, Notion, HubSpot, AWS, all the big cloud and SaaS platforms run startup programs today. For them, it's obviously a go-to-market tool. They give out free credits and free discounts so that their assumption is when these startups grow, scale, raise money, they will become permanent customers and paying customers for these companies. But what that means is they now have a massive database of startups within them. So if you could find connects, and a lot of these programs again are public, to reach out to people who run these programs, that gives you early access to some of these deals. The second thing that the startup company programs do is organize demo days and investor connects. So typically, every now and then they'll organize an investor connect, and being part of these networks mean you get invited to those connects, and you get to see some of the more promising deals earlier on. And these are, of course, more exclusive deals. So these are the two ways. One is by participating in the investor connects, and second is to tap into the larger database of these early stage companies. But SaaS company startup programs specifically cater to very young early stage companies, and their database again will literally run into thousands. And finally, follow industry think tanks and initiatives. I think another massive kudos and applause to all the funds and the industry partners, ICAI included, who have been organizing so many such events to showcase startup founders and to bring about and to encourage entrepreneurship. So we have SaaS Bhumi, for example, which is again a network which covers SaaS, or this Excel Seed to Scale. At Waterbridge, you can see the logo behind me. We run a program called Fast Forward in the seed stage side. But there are multiple initiatives like this across the ecosystem, where again possibilities to source deals and to make investments arise. And you just get to see a large volume of deals in a very compressed time frame. To give you some examples, I think as part of Fast Forward, we see anywhere between 600 and 1,000 deals in a month. So that's the volume of deals that come through. And so again, like I always say, the more deals you see, the more patterns you establish, the more sector trends that you begin to analyze. You start quickly creating these mind maps on what are the common sectors, what are the uncommon sectors, what are the good business models, what are the weak business models, and it helps you evaluate your own deal sourcing with what, say, some of the external programs are sourcing you, and it helps tell you whether you've indeed found something unique or you've found something which everybody else has. But this is not an exhaustive list, but this is I think a great start. I think I put this list keeping in mind what you could start, and more importantly, a lot of points on this list is something where you could start tomorrow, where there are no dependencies on people or organizations. And many of these simply require signing up on websites or following LinkedIn pages and actively participating in the ecosystem. Last couple of slides, and then happy to answer all the questions that are coming into our chat box. We have budgeted for the last 30 minutes to be designed for Q&A. But last thing I would say is that it's very, very important to build a personal profile as well. And these are, again, small, simple things. One could be to write actively about your deals, actively promote your founders. Doesn't matter if you're only invested in one company, but put out a small article on LinkedIn, on your own Medium blog, on what you liked about the company. Actively share about the founder in your own networks. Help him find, like I always say, the 360-degree approach. Help your founder find his first customer, his first employee, his first vendor. And these things will go a long way, but actively promote and participate in the deals that you have. Participate in ecosystem events. As I mentioned in the previous slide, I also stated names of many, many places, and just being visible, participating. I'm not saying commit and invest right away, but just participating and being visible, making your investment preferences public would also mean that founders find a way to reach you. I think, how do you make founders find a way to reach you? This is all the more important in a COVID remote working, virtual first world. So it's important to build out a profile so founders, as they get to know you and hear about you, that there's also a way for founders to reach out to you. And of course, participating in ecosystem events also gives you competitive knowledge, deal insights, deal intelligence to stay updated all the time. Be visible. I think this is more of the same thing, that it's important for founders to find you as well. And publish sector insights. I think I'm personally a very, very strong believer. There is nothing like a generalist investor. I think everybody, given how complex business models are and how quickly these business models are evolving and how the world is becoming flatter every day, it's very, very important to have a sector focus. So I would really encourage you to have one or two sub-themes or subsectors that you're very passionate about, or that you believe come very naturally to you, or where you have strong networks, and write about your sector theses, publish sector insights, talk about them in forums, but find a way to be visible about these preferences, so that founders building in these spaces naturally gravitate towards you. And finally, develop a niche or a core. As I was saying, don't try and be a generalist, try to be a specialist, try to find a way to value add. And it doesn't matter if you only want to do ed tech, or you only want to do healthcare. You rather be the best and get access to the top deals in a small niche, than try to play in a very, very broad generalist sector agnostic play. So I would encourage you to have 2-3 things that people can recall as being your superpowers, if I may, or being your niche or your core. So just, again, personal brand recall and retention within founders is higher. Finally, to conclude, before we open up for questions, I would say, what does all of this lead to? And I'm just going to pause again for a minute. And I've put out just 2 words called adverse selection here on the slide. And we'll just encourage all of you to think about, why adverse selection is a very, very, very high probability of adverse selection happening in angel investing. Great. I think we'll dive right into Julian is a writer and investor that I admire and I follow. And incidentally, there was a quote just this week. I think everything I told you is fantastic, but do remember that there are 2 sides and 2 coins to every relationship. And invariably, whether it's founders, whether it's other angels, whether it's investors, they'll invariably share deals with you that either they don't like themselves, or they will it's human nature, behavior. They will share deals with you that are not getting filled, or what we mean is that they're not getting subscribed to or invested in. It's always good to question as to why did this deal come to me, right? And so the only reason somebody will come to you, like I said, is because of what value add you bring. So if you don't have a niche, if you don't have strategic value, if you don't have, if you're not visible and you don't have high brand recall, then you might just end up by just generally networking on the periphery or superficially, you might just end up getting access to deals that are not getting filled or get too many deals. But it's really important to focus on depth of relationships rather than width of relationships. So while I myself have put out several sources, distribution channels, networks, I would sincerely encourage you to also build a circle of trust, to build maybe like one person in each of these spaces who you can trust, who you send high quality deals to, and from where high quality deals come. And therefore, remember that depth of relationships matter much more than the width. And so focus on building certain high quality relationships so that it's not just the leftover deals that come to you, but you get invited into deals. I think one measure of your own success as an angel investor is when the outbound flips to inbound, and when you start getting invited to join cap tables. Final slide, and then opening up to questions. And I think always think long term. Remember, it's the long game always. So look at the trajectory and the direction rather than the daily ups and downs. I think remember that velocity is always more important than speed. And finally, investor beware. I think these are a set of my own personal experiences and opinions from my journey. But always make sure that I just want to once again reiterate that it's a risky asset class. So do your diligence and investor beware. With that, I'd like to conclude my presentation and look forward to receiving questions and answering them from the audience. And Shreya ma'am, back to you. Thank you so much, everybody.
Thank you. Thank you so much. What an insightful session. And now that I can see, there are quite a few questions. So I think this is going to be interactive. So yes, the first question is by CA Raghavendra Singh. And he wants to know what is the basic difference among angel, seed, and round funding.
Great. Thank you, Raghavendra Singh, for asking this question. I think let me just maybe go to that slide. So I would start off by saying that angel is the very first round of investment that a founder gets into their company. Seed would be the next round. And then when we start calling round names, which is series A, B, C, D, these are like the rounds that happen. This is the subsequent round. So this is literally just the hierarchy or the order in which a company raises money. So simply put, you start with angel, next is seed, series A, B, C, D, E. So if you look at a Flipkart or a Swiggy, I think they're already in J or I or something. I've lost track. But it is literally the hierarchy in which a company raises money.
Perfect. Next one is by CA Abhishek. And he says, coming to a very basic question, where to find and get in touch with angel investors or VC network? Where should be the first step?
Yep. I think it's what I mentioned on my slide in terms of just interacting and being part of other angel lists, angel syndicates. I think that's a great starting point, as well as ecosystem enablers. Like I said, COVID has made this democratic, and it's literally just start by following something as simple as following LinkedIn pages and participating in demo days, participating in events. BITS, like I said, next week they have a campus demo day event. So I think firstly it's being visible, and then once you're visible, getting and gaining access to angel lists, to formal angel syndicates, campus events, campus incubators, and then taking it from there. But these are things you could do starting tomorrow. Yeah.
Okay. So the next one is by CA Primal Trivedi. And the question is, what is the average degree of ethical and transparency observed in failed deals?
Fantastic question. Thank you so much for asking this. I think it's very, very important to recognize that there is a fair amount of opaqueness in the early stage ecosystem, given that we're talking private markets. here. So I think it's also important to recognize that, as I said, these are very young businesses. In many cases, these are companies that have not even started earning revenue. So these are typically just past an MVP, and therefore, if I look at it from their books, it's largely cash burn businesses, right? So every good founder will be transparent, and every good founder will put governance as a top priority. So even if you're an angel investor, even if you're the smallest investor on the cap table, I think it's fair to expect quarterly updates, if not monthly updates, depending on the stage of the company. And if you don't, it's fair to ask for them. So I would really encourage investors, and please don't consider the size of your investment and hold yourself back as a result, but to actively seek out updates from investors on progress. And this also comes to the point I made earlier on being an active versus a passive investor. I think some of this naturally happens if you're involved with the founder, if you know the founder from before, if you trust the founder, because a lot of this is investing in the founder. In many cases, there is no business, there's no historical track record for the business. So you're investing in the founder more than the company. So first and foremost, I would encourage you to only back founders that you already know, that you've ref checked, that come from your existing network. But if not, if this is part of a larger deal, you're a tag-along investor, as I mentioned, please actively seek out reports. And the best founders always send monthly and quarterly updates to investors and take the trouble to explain ups and downs in MISs and cash flows.
Great. I'm sure this was helpful. Next, we have from CA NK Somani. And the question is, what is the normal ticket size for VC investment? And VC investment remains for first investment or subsequent as well?
Good question. Again, I think ticket sizes are changing very frequently. Since the slide is up, you could see that seed rounds, where a lot of VCs, including us, participate in seed rounds, and the average in India is like hovering at 600K roughly. So I would put the range between 600K all the way here to 5 million as the first check, meaning the first round that I participate in. And every VC has a different strategy, but this is a very important question to ask a VC. I think I always say that founders don't ask this question enough, but always ask a VC typically, what is your first check to follow-on check ratio, and how much money do you allocate between your first check and your follow-on check. At Waterbridge, we typically have a 30-70 rule. So 30% of the fund goes into first check and 70% goes into follow-on. So we do reserve significant capital, but different VCs follow different methods.
Okay. This one's from CA Shifari, and she asks that, can you please explain what is accelerator program?
Yeah, for sure. Accelerator program is typically when a very early stage company, typically in an idea stage, enrolls themselves into, I would say broadly, two types of accelerator programs. One is you join a corporate accelerator, and one is you join a generic accelerator. Corporate accelerator could be, say, Target, for example. Target is one of the world's largest retail chains. So if me as Anjali is trying to start up in the retail tech space, makes sense for me to be part of the Target accelerator program. Because they're industry specific and they can add value to me and help me build and even serve as the first pilot customer in many cases. Generic accelerator programs are also plenty today, but broadly an accelerator program is where early stage, idea stage companies get into a program. It's typically run over 6, 8, 12 weeks. It's like a boot camp, I would say, like a startup boot camp, where you test your product, you pilot your product, you try to secure your first customer. And it's really that 0 to 1, going from idea to MVP and getting ready for commercial release. So it's really like a test bed in those first 6, 8 weeks of like intense, studying and prepping your business model and getting ready for launch. Many people at the end of the accelerator program drop out, like they feel that starting up is not for them. So it's also a good way to test yourself on whether starting up in entrepreneurship is really for you or not. Yeah.
This one's from by CA Anurag Gupta. For someone new, how can one start studying different sectors, and what resources that are available for the research? Any book?
Yeah, I think this is a very broad-based question. I guess it really depends on what your personal interests are. So I don't think sectors can be forced on anybody. So I would encourage you to go with what you personally have always liked, or like I said, the companies that you're worked in where your own professional experience is, and always use your advantage to your advantage. See where your own experience lies, or where your own interest lies, and then focus on that. And depending on what sector it is, I would encourage you to read more about that sector. Yeah, but it has to be something that you like doing to begin with. Yeah,
your personal interest accordingly. This question is by CA Kishore Kumar. Will value add service deemed investment with agreed value at the inception?
Sorry, could you just say that again?
I think the question is a part is missing. Right? Okay. If you can catch, I think I'll ask from the other one. This is by CA Suresh Kumar. Will there be any ETFs or MF for investing in startup rather than directly investing and managing?
No, I think by definition, no. But angel syndicates are structured very similarly. I think the structure of it and the concept of it is of being part of a formal angel syndicate or a fund manager is the same. So conceptually, it works the same way, except that the markets are public versus private. Yeah.
This is by CA Animesh. Are there angel investors available for chain of restaurant projects, as this is a losing industry in this COVID age?
No, the very specific question. I think I agree it's a tough industry given COVID upheaval, I would say, but it comes back to horses for courses. I think it's important to find angels who are already prominent in that space because they'll understand your pain points better. But if you go to a generic investor, say like, if you come to a consumer tech investor, say like me, I might say I don't want to invest in a restaurant because it's too risky and I'd rather invest in an online company that continues to function through COVID. So I think horses for courses is very important, and finding the right investor of the right business model is super, super critical, but tough space, no doubt that it's been a hard time for that for the restaurant industry.
This one's by CA Aishwarya. How do you deal with dilution as an angel investor? How much dilution can we expect?
Yeah, fantastic questions, by the way. I think I would love to say as much as you want, but we all know that like most things in business models, it's about supply, demand, pull and push. So it's a negotiation with founders. It's the first round that they are diluting. So remember that there are many rounds ahead and many more dilutions ahead for the founders. So don't be too greedy as well, as my suggestion. And anyway, in the best rounds, you don't get to negotiate. Very honestly speaking, in the best rounds, you're joining a group of people. So there's also power in group negotiating, which is why you should always like have a peer group and try to invest together. But it's classic pull and push, and could range something as low as 5% and go as high as 20%. I would say, depending on the momentum of the deal.
Great. This is by CA Sujit Kumar. What are the main reasons for the failure? If you can guide, please.
I think they say, with failure, you can always find many reasons. So it's a tough question to answer. But, I think the best way to answer this is philosophically. As I said earlier on, I think failure in entrepreneurship needs to not be stigmatized. And the very nature of this asset class is that only the top 10% will survive and do well and generate returns. So failure is part of the business model. So I think if you're inherently averse to it, then I wouldn't recommend the asset class itself for you. So that's I think the best way to answer it is that way. It's part of the learning curve. I think failure is necessary to learn in the startup ecosystem.
Great. I think there are a lot of questions I think that you have covered in your session, which talks about where they can start. So this is the question by Ravindra Bhandari. What is the security generally asked by the angel investors?
Typically nothing. By very definition, since it's an equity, so I'm just moving to the network slide if anyone wants to just write down, since I got a few of that. Since you said many people are asking where to start. Yeah, I'll just keep this slide up while you answer. Sorry, I forgot your question, Shreya, if you don't mind.
Yeah, absolutely. What is the security generally?
Oh, security. Yeah, no, typically not at all, given that these are equity investments. So I would say no to a founder who's asking you for a security.
Okay. Yeah, the same question. Some startup groups that you can suggest for networking.
I've put up this slide so that folks can quickly jot down.
Yeah. So this is the question by CA Kartik Agarwal. Should the angel investor deploy a financial advisor to see how the money introduced in the company is being used? Is there any norm?
I think because this is early stage, there are no norms per se. I would again encourage you to have, as I said, this is a lot about trust. So putting in a financial advisor for right at the very beginning might send a wrong signal saying that you as an angel don't trust the founder and therefore you're putting in a financial advisor. I would encourage you therefore to do it on your own and yourself, which would just help build a better relationship with the founder rather than sending in a third party. And always I encourage you to be an active investor, not a passive investor, and therefore build that rapport and relationship so founders voluntarily share updates rather than having to formally appoint an advisor.
Okay. I think we'll take a last 2-3 questions. So this one's by CA Sridharan. And the question goes like, to protect the interests of the angel investor, is it worth to seek a seat in management committee or board or watch for the progress? What would be a good option to exit route while angel invest?
Fantastic. We have very, very knowledgeable participants and so heartening to see the depth of the questions that are coming. I think it's again, it's hard to say it's a negotiation. Many founders are wary of giving angel investors board seats. I think I always say no harm asking. Better to ask and be told no rather than not ask at all and live with that regret. So I think if not for a board seat, ask for an observer seat. And definitely, as mentioned previously, seek out updates and make sure that the MIS and the financial information and monthly and quarterly business updates as well are being shared with you routinely. And all of this comes back to relationship building, investing in founders that you already know, so that some of this happens organically, that you don't have to seek it out and there's already trust established before the investment itself. Otherwise, some of these things, given the momentum and the speed with which companies scale, some of these might be hard on the founder after the investment to try and tell the founder, now let's try to get to know each other. I think the getting to know each other has to happen prior to the investment. Yeah.
Now, this one's by CA Vishal, and he asked that which country, as per you, is good for company registering for startups? Is India good?
Yes, I think at the early stage, definitely. I don't see the need to incorporate outside. I know a lot of companies do it at idea stage itself. They go and incorporate outside, but definitely not. I think the regulatory regime is very friendly to startups currently and would encourage people to stay incorporated in India because you can also access more capital pools here.
And this one's by C. Aditya. Can you please talk about convertible note in India and its use? Since valuation is difficult, the C note better vehicle from investor point of view.
Yeah, I know it's safe or like, as we say, like a simple alternative form of equity, SAFE. SAFE is becoming very popular for the same reasons you mentioned, which is it's fast, it's easy, you don't waste time negotiating a valuation. A lot of the accelerator programs and incubator programs also issue in SAFE. Again, no right or wrong. I think every investor has their own preferences. I wouldn't shy away from doing a convertible as an angel. If you have like high conviction, don't make that a deal breaker is my advice. Having said that, at Waterbridge, for example, we have a policy of not doing convertibles at all. We price all our rounds. But it's also a function of the larger ticket sizes that we checked. We just feel that entrepreneurs should not be distracted with valuation. We should agree on price. And that risk needs to be priced, and let's not keep any loose ends. But each their own, depends on size and stage, I would say. Yeah.
Right. This is by CA Satish. He says that you mentioned EV in the negative list. Can you please throw some light on it?
No, I just mentioned it as an example, not, I didn't mean that it's a negative list. For me, in fact, climate change business models are on the positive list, but it was hypothetical.
This one's by CA Anirudh. I think probably we'll take this as the second last question by CA Anirudh. And he says, how do you evaluate when is the right time to exit?
I think $1 million question saved for the last. I think it depends on your investment horizon expectation. And what I mean by that is, are you comfortable staying longer? I mean, it goes without saying that these investments will compound more over time. And so therefore depends on your own cash flow needs. I would say if you don't really need the pressing need for the cash or the exit, then continue staying, because exit later on and get better returns. These are private markets, so these are not public markets. So in many ways you can time your exit. But having said that, it's also illiquid, so you'll have to find a buyer yourself. And typically exits only happen when the next new incoming round of investors come in and they're willing to give the early stage investors an exit. So a large part of it is again not in your control, but in the founder and the company's control. But ideally, founders would like everyone to stay invested, so it sends the right signals to incoming investors as well. So I would say look at it more from your own cash flow needs. But if the company is doing well, obviously always stay till the IPO or stay till the big unicorn rounds. Yeah.
Nice. So I think, yeah, we'll seal the Q&A session by this one being the last by CA Aishwarya. And she asks that, what are your views on the current marketing analytics industry? Is it saturated, or is it a good time for investment and growth potential?
Yeah, again, great way to end with the Q&A. But Aishwarya, I think I'm personally bullish on the space, but I assume within marketing analytics, specifically anything with online digital analytics is something which is definitely going to have a bull run. I think specifically social listening tools, for example, traffic attribution tools, for example, I think these are some spaces which have a very bright future. Just given the number of online transactions, online payments, e-commerce, and the entire shift to the overall like digital economy, and the fact that most businesses today are spending a lot of marketing dollars on Google, Facebook, and more online marketing dollars than offline traditional ATL marketing dollars. So short answer is a yes, but of course, caveat to it depends on the specific space and the business model.
Great. Yes, so I think here we end the Q&A session, and bringing to the full circle, I'd like to firstly thank you for your excellent deliberation, ma'am, for the lucid presentation, and for such amazingly answering all the answers in real time to all the questions of the participants. This has been a great session. I'm sure everybody has been beneficial to deals, and more deals, the second class. I'd also like to take the opportunity to thank the leaders of the Committee on MSME and Startup, the Chairman, CA Dheeraj Khandelwar sir, and Vice Chairman, CA Pramod Jain sir, for starting the first year of the committee and with a boom. I think every now and then they're hosting webinars and there are classes for people to know more in the area and to look for more opportunities in startups as well as MSME. I'd also like to thank the entire secretariat of the committee, starting from the secretary, Dr. Samdip Mishra, and the entire team for pulling it out amazingly. And last but not the least, to the participants for their active participation. This has been an amazing second class to our master class. And now get ready for tomorrow. Tomorrow we have the session at 5 p.m. and it's going to be about valuation. So yes, let's see you all tomorrow at 5 p.m. Right? It's 5 p.m. Yes.